chart a path. And it just reminded me as they were talking. I once talked to Janet Yellen, who said to me that her biggest mistake at her first press conference was answering a question. So I think if you remember the first one, I think what he's going to do is basically try and say nothing, just try and calm nerves and just say, we're here, we're ready to act. This is an economy that's improving, but it could be hit by all kinds of things coming in if there's a second wave of the virus. So that's what I would be expecting. Nothing much, and trying not to sort of nudge anything.
All right, with about 2.5 minutes to go, Priya, jump back into this conversation here, because is the market going to actually accept nothing here? When you talk about pricing in this market, 94 basis points in the hole right now on a 10-year yield that, quite frankly, was 111 basis points in the hole just a few months ago here. What's changed now since the last Fed meeting and this Fed meeting that's going to make the market actually pause if the Fed stays on pause?
Sure. So I think the Fed I think Chair Powell needs to calm the market on both sides. There's definitely a concern now that inflation is overshooting, that it is not transitory, and that the Fed may be behind the curve. And therefore, if they have the tools at some point, do they trigger a recession? So I think we need to hear from the Fed this idea of vigilance, that they will tolerate an overshoot, but not forever, that they will not trigger a recession. I think that's why they have to calm people down on those who don't expect the inflation overshoot and those that expect the overshoot. And that's why I think he has a tough communication challenge today. I think he will be dovish, but suggests that they are vigilant, that they are talking about the eventual taper.
Priya Misra of TD Securities and Professor Blanchflower, thank you so much for your patience with the President's press conference, and we will do this again and soon. Valuable conversation there as well. Romaine Bostick mentioning the equity market, so it's a negative 145 on the Dow, the VIX 17.44. I look at, I go here, Lisa, and I've just got to go back to the 10-year yield. It's barely budged. I think we got to go up to 6 digits to show some movement.
The idea here that even as we see oil prices generally rising at around their highest level since 2018, even as we see people talk about inflationary pressures, a 1.485% 10-year yield gets your attention, Tom.
Yeah. It is the Fed decides. We never had a chance to reset, and we do so now for radio worldwide and across this nation. And a good afternoon on Bloomberg Television as well. We've heard from the President of the United States and the President of Russia in Geneva. Thanks to our team there for all of their coverage as they make the trek back to Washington. And, of course, on Feds Decides, we need to make the trek to the analysis of Michael McKee, and we'll do that here in a moment. After that, we've got wonderful conversation with guests that folds into economics, into finance, and into investment as well. Again, the Dow negative 153. And now let us go to Michael McKee as the Fed decides.
Well, Tom, there is no change in rates, but there is a change in when they might rise. The Fed now sees the first rate move in 2023, pulling it forward. The dot plot changes. 13 of the 18 members of the Open Market Committee now see a move in 2023. In March, there were only 7. The average rate they see is 0.625%, which would suggest just one rate move, a range probably from 25 to 50 basis points with the possibility of another. And it also looks like they see 2 people see it at 1.75% and 2 at 1.25. So it could move if inflation continues to move. Now, the statement has very few changes in it, and it does not change the language on inflation. They say inflation has risen, largely reflecting temporary factors, and they keep the line about inflation running persistently below 2%. But they do change the outlook for inflation and for growth in 2021. Instead of inflation at 2.4%, which is what they saw in March, they now see it at 3.4%. The core rate goes from 2.2% to 3%, and they expect it to drop back, both of those to drop back to 2 and 2.1% by 2022. GDP this year is going to be 7%, the Fed says. In March, they thought 6.5%. The unemployment rate unchanged at 4.5%. The assessment of the economy is pretty much word for word the same, except the Fed does note that progress on vaccinations will likely continue to reduce the effects of the public health crisis on the economy, but risks to the economic outlook remain. And one last thing, they announced the extension of their temporary U.S. dollar liquidity swap lines with 9 other central banks through the end of the year, but there is no word on administered rates at this point.
We are well rehearsed here, and we're going to have to go to Michael McKee on the level of surprise here. But Romaine Bostic, I'm going to have you dive in here. What do we do, Romaine? Do we go down 1,000 points to start the afternoon?
I don't know if we go down 1,000 points, but that sound you hear is a lot of people reopening their Excel spreadsheets here and recalculating, I think, what goes forward here. You saw an immediate knee-jerk reaction in all of the major equity indices, S&P 500 around the lows of the day, as are a lot of those cyclical names that had gotten bid pretty higher. Those are leading the market pretty lower here. You're also starting to see a lot of softness come into the market with regards to gold, precious metals, as well as some of the other commodities as well. Oil pretty much flat on the day. And of course, Lisa, we did see a nice little pop there in that 10-year yield, 152.
For John Farrell, we got to quote the Dow Jones Industrial Average.
There you go. I forgot. 34,022. Should I give you the actual cash price or futures?
No. I want the cash price down 300 points.
All right, moving on.
So much for that.
We got to check
Lisa, we got to move on and talk about the real yield here. You take the 10-year yield and whatever the dot plots and Michael McKee's inflation expectation is, and I'm looking at a negative 0.90. That hasn't moved much, has it?
Which is actually the interesting part. That is exactly what I wanted to hone in on. Yes, we're seeing a lift to the 10-year yield right now. It is not as big as you would expect, given the fact that they're projecting 2 rate hikes in 2023, as opposed to really beginning that liftoff cycle in 2024. The lack of market action, I would argue, Tom, is highly notable given the surprise factor, with so many people expecting the Fed to keep the language the same.
Michael McKee with us before the press conference. We always know he tries to get the first question and ends up with the last question. Maybe if he takes his coat off like President Biden at a presser, he'll do better. Mike McKee, what is the level of McKee's surprise here?
I'm a little surprised by the fact that so many Fed officials changed their view for 2023. Obviously, the consensus seems to be that the economy is recovering much more quickly and that growth and inflation are going to be higher, and that maybe means they need to act sooner. Although they're still very cautious, a large group did move. We thought there might be 1 or 2. Instead, 6 additional Fed officials switched to 2023 for a rate increase. And so there does seem to be a consensus that they may have to move sooner rather than later.
Scott Minerd with us this morning as well with Guggenheim, I should say this afternoon. Sorry, Scott, I'm on surveillance time here as well. Always an important voice, and the market's moving here so importantly. The nuance, Lisa Abramowitz, of this Fed is so important. We're going to go Bitcoin free with Minerd this afternoon.
Really? You're going to guarantee that? I don't know. I think that we should perhaps ask him about that. I think that we might not be able to make that guarantee, Scott. I do want to ask you, though, about the lack of response that we're seeing in markets. The idea here that we got a surprise. The Fed is going to signal perhaps that they're going to start tapering sooner than some people expected in order to get to that rate hiking cycle in 2023. Why is the market so sanguine about this right now?
Well, look, I think that my feeling was that if we got something that sounded hawkish today, that there's a very good chance that the bond market will believe that the Federal Reserve is trying to stay ahead of the curve on inflation, and therefore there would be limited pressure upward in rates, and so it might be a buying opportunity. Now, right now, if you look at the charts, you'll see that we're still below 155 area, which is where we broke down in yields. And the downtrend that's been in place ever since the beginning, sometime in March, whatever time that was, is still solidly in place. And I'll add one last thing is, people have been fighting this rally for months, and basically it's the pain trade. And so I don't see any reason to take hawkish news, as you might say today, as anything but positive for the bond market.
When you look at this statement, though, Scott, do you get a sense at all that maybe the Fed has changed their positioning on how much inflation they're willing to tolerate?
You know, I don't think so. I think that they're obviously betting strongly on the transient argument. Our own work shows that, today where we have, PCE or core PCE, I think somewhere around 3.4 year over year, that by the time we get to this time next year or close to this, that core PCE on a year over year basis will be 1.6% once you get these one-time shocks for like cars and airfares and hotels out of the way. And so, and I think they can do the same calculation that I can do. But it is a little surprising to me, and I agree with Mike, that there were that many people and that would want to think that we're going to raise rates in 2023, and the degree to which they were committed to it.
Scott Miner with us. We welcome all of you. The Fed Decides on Bloomberg Radio, on Bloomberg Television Worldwide. Romaine Bostick for John Farrell. Thrilled that Lisa Abramowitz with us this afternoon as we look at some of the challenges here of the Fed in conversation with Ms. Minard, Mr. Minard. Ms. Swank will show up. Diane Swank will show up here in a bit. Some other good guests. Neela Richardson scheduled to be with us later on. Michael McKee scheduled to be with us right now before he wanders into the press conference. Michael, how does this decision change your question to Jerome Powell?
Well, it depends on whether I'm last again. But if I'm first, I'm going to be asking him why the move in 2023. Does the Fed see a sense of urgency in tapering that it goes along with moving forward when they would raise rates? And so does that change their thinking about tapering? One issue that they have is that they've promised this long runway to investors, a lot of notice before they begin tapering. Does that shorten now? Do people have to prepare for perhaps a different world?
Scott Minard of Guggenheim, is this realistic for the Fed to start tapering and get down to $0 per month of bond purchases ahead of 2023 in order to raise rates twice without disrupting markets enough to stymie the economic recovery enough to stop them in their tracks?
Well, you know, it's interesting, and I got to give Mike a lot of credit for that last press conference. It really, you did befuddle the chairman, and I have it here in front of me to reread.
Oh, here we go.
Let me go through my analysis. Let me go through my analysis. They told us they weren't even thinking about it. So the best we're going to get at this press conference is they're going to start thinking about it. Our next meeting, they're going to be thinking about it. The earliest we're going to get an announcement is probably September on tapering, and then based on history, we shouldn't expect any real action until we get into the late first quarter or to the this early second quarter of next year, and then it'll probably take them about a year to taper. So they won't even get done with their tapering until early 2023. And then history shows us that they typically wait quite a while before they start raising rates. So if they're going to be true to their word, and I think they're really trying to be true to their word, but as you know, as much as they can be as vague as possible, the reality is that's the timeline they've sketched out. And any change to that is just going to be perceived as hawkish.
All right, so then we go forward here. There's a communication issue here, Scott, that I think caught a lot of people off guard here. The general idea is people were expecting maybe the Fed to move a little bit sooner than I guess some of that 2024 pricing that we had earlier this year here. When Powell comes up to the stage here in about 20 minutes time here, what more can he say in your mind here that would actually maybe calm some of the nerves about what the plan is?
I think that if he sticks to his rhetoric, which is this vague communication where he to be quite frank, when you read the answer that Mike received in his last press conference, there was a lot of stumbling around when it came to asset purchases. And a lot of phrases like, you know, the last time, this is, you kind of know what we did the last, right? I think that he's going to attempt to pull that off. And if he doesn't do that, and then he fumbles this, then, we could see the market sell off. But I don't really think the chair will really say anything except make vague allusions to the possibility at some point after they've been thinking about it, that they're going to make a decision and actually start to move.
Scott, this is Mike. I don't usually get to ask this, but I'm going to put you on the spot. If you were me and you were in the news conference, what do you want to know from the chairman? And when I say that, I ask advisedly that you ask him something that you know he'll answer instead of just saying transitory.
Well, I think the number one question you really want the answer to is what is substantial further progress, right? Mm-hmm. And what I hear, he talks now about a 3-part test. And what I'm basically hearing is that we're going to push unemployment rates to a level where the differential between various groups of workers is much narrower than it was in the past. And Mike, I just read a white paper from the NBER from 1995, and they were discussing the policy in the Kennedy administration. They believed that the frictional rate or full employment was at 0. So, are they willing to risk inflation rates that are above 2% to get to a level that satisfies these other tests?
Yeah, that's a really, really important question. What we're going to do is let Michael McKee go. He's got to recalibrate after this. It was not a snooze fest. This is an important moment with the Dow down 217 points. Romain, very quickly here, you're looking at those big stocks nobody owns except I don't own them. I'm the only one in the country that doesn't own them. Yeah. What are the FANGs doing real quick?
They're down on the day. A lot of those stocks, of course, had gotten a nice little bid over the last couple of days. Microsoft down about 1%. New York FANG Index was higher on the day, now in the red, but going in the opposite direction, Tom. You got bank stocks getting a nice little bid. They came into today lower. They're now pushing higher with the exception of Citigroup, but that's a little bit more of an idiosyncratic story.
Okay, idiosyncratic. That's an afternoon game that we play here on the close. This is going to be really interesting, folks. I thought this was going to be boring.
Nope.
And it is not. Scott Minerd, what does this mean for American Wall Street? I mean, it is somewhat of a sea change. We're seeing it in market response. How does the calculus for Wall Street into the summer, into the end of the year as they replan budgets for next year? What changes today?
Well, I think, look, this is going to put, if he validates the idea that there's a possibility they're going to move earlier, he's going to have a lot of pressure coming out of Treasury, and that the economy needs to keep going. I think the other important factor would relate to the fact that if people start to believe the Fed is moving early, then, we've got a repricing of the stock market ahead. And, Tom, as you're aware, we're in the second year of an expansion. The average decline based on Ned Davis work is that we should expect an 18% pullback. So I think we're in a really vulnerable period here for stocks. And, I think between here and when the Dodgers win the World Series in October.
You're killing me. Come on. You do this. Can the staff make a moment? I don't know here. The Padres are 2-8. The Dodgers are crushing them. But this is Minerd's last show. Scott Minerd, go away. Thank you so much. With Guggenheim, their global CIO this morning. Never again are you coming on. We will see you. Romain, you have 4 or 5 boards. And actually, folks, from the Snooze Fest, we go to board number 2. I feel like let's make a deal. Yeah, Romain, board number 2 is pretty good.
Board number 2, you can put my White Sox AL Central leaders up there in a second here. But let's take a look what's happening here, because I can know whatever the opposite of Goldilocks is, this might actually be what's starting to unfold. At least right now, you're seeing a lot of those cyclical stocks get sold off. You're seeing a lot of those big cap tech stocks get sold off. The only thing really getting bid right now are some of those bank names. You're seeing a modest spike here in volatility. The VIX right now camped out at around 18. And there's your 30-year yield if you want to go a little bit further out onto the curve right now, hanging out, Tom, at around 2.2.
This is Lisa Bramowitz's wheelhouse, folks. Yeah. Long before I knew how to spell Lisa, L-I-S-A, she was one of our bond aces, and we had a banner go across Lisa measuring the difference in yield between the 5-year and the 30-year flat back to where they were ages ago. I mean, that's a big deal, right? Well,
and actually, if you take a look at the gap between 10-year and 5-year Treasury yields, it is actually contracted significantly. What this is, just to put it into plain English, people are starting to sniff out a policy error here. The Fed raising rates faster than perhaps the economy can handle to go at the speed that they previously had priced in. And so you're going to see longer term rates come back in once growth slows that much more as the Fed moves away from their accommodation. Tom, this I am watching very closely. It has big implications in the economy, and really it could influence whether the Fed goes ahead with the projections that it has in the dot plot.
It is the Fed decides on Bloomberg Radio and Bloomberg Television. It was to be a calm meeting, and as Michael McKee said, in into the press conference is anything but the Dow negative 300, 0.8% move. NASDAQ, remember there's S&P. I sound like I'm President Biden. I'm not that old. The NASDAQ down 1% right now as well. The VIX is out a full one figure, 18.35, showing some of the equity dynamics. We should note in Geneva, President Biden is getting ready to move out on Air Force One, back no doubt to the fun of Washington. Right now, it is our great honor to speak with Diane Swonk of Grant Thornton and their chief economist. And the thing that is so lovely about Diane Swonk is the pulse of what goods and service sector GDP is. Diane, what an interesting meeting all of a sudden. And the backdrop is a boom American economy. What is the Grant Thornton call on how this economy looks as Jerome Powell prosecutes Fed policy through the rest of this year?
It's a boom economy. I mean, we had the strongest economic growth in our forecasts in the last cut since the 1950s. Let that set in. 70 years. That's really stunning. It's a tenth on whether or not it's 1984 or the 1950s, but, you know, we're talking about a boom economy. Even as things slow down a bit in the second half of the year and you go into the strongest quarter of the year will be the second quarter, which we're coming to an end to now. But I think it's really important that the Fed is responding to exactly what it said it would, and that is the data as it comes in. Inflation and the flare in inflation has come in much stronger than they thought. And I disagree a little bit with Scott, although I love Scott. And, you know, I think, you know, I call it artful dodger when Jay gets up there and talks about, you know, in terms of not committing to quantitative easing and what are they going to do with QE in terms of the tapering. But I think it is important to understand that they've acknowledged now that the economy's coming hotter, it's coming faster. What Jay will be doing is also saying, but employment is a disappointment. And how does the Fed look at that? And I think you're going to hear him talking about more uncertain about things like retirements and that. And I also think it's important for the Fed to, you know, think about in terms of moving this up. I was surprised by the number that moved up to 2023 as well. And I think Lisa really hit the nail on the head when she was talking about what are the risks that we see a sooner pullback, and the Fed could precipitate a mistake that ends up in a recession after a boom. Well, Diane, and I think that's something we do have to think about.
Since you liked what Lisa said and not what I said, Lisa, why don't you quiz Ms. Swonk here about the path forward?
Well, that's what I was going to ask, basically, Diane. What is the potential implication if the Fed were to go through with what is projected in the dots, if they were to raise rates twice by 2023, which implies a removal of the bond purchases on a monthly basis? Do you think that the economy would be strong enough to keep going? Do you think that this would be a smart move based on the trajectory of growth?
Well, actually, I already had that in my forecast, so my simulations suggest we can get through that. That said, it could be much more rapid as the inflation numbers continue. And I think what Jay Powell really has to start to get to deal with is what does the Fed actually consider transitory? And one of the things we're concerned about is that there is a big transitory piece of this. We know the base effects start to play out as we get into the summer. That's the effects of things falling in price, you know, during the height of the crisis. But the other part of this and the other shoe to drop is things like the components of shelter inflation, which is over a third of the CPI. That's going to start to heat up. That did decelerate quite sharply as rents fell in inner city districts and urban areas. That is going to pick up, and you're going to see some of the housing market increases we've seen. Actually, single-family housing rents have picked up quite dramatically. All of that's going to show up. It's not going to necessarily make the economy really hot, but the Fed's going to have a much easier time hitting their 2% or a little above target. And I think this is consistent with that.
Romaine Bostic, S&P 500 finds new lows off of this important announcement.
Yeah, lows of the day right now for most equities. Of course, highs of the day right now on yields. Lows of the day with regards to some of those metals. Gold are really taking it hard here, Tom. And you talk about the dollar, something we haven't talked about here. We should point out that the Dixie and the BB Dixie up about 0.6% and well above some of those key moving averages, Lisa.
And I saw Euro 120.41 on Euro breaking down as well. Really, you know, okay, folks, all the people say boring, boring, boring. Lisa, this is not boring, is it?
No, and honestly, a lot of people expected this to be pivotal, this to be one of the most important press conferences ever out of the Federal Reserve. It's a pivot point for them, trying to recognize the strength in markets and the strength in the economy, while also treading carefully in an economy that has had slow slow growth for so long. Diane, do you think the Fed ever could remove accommodation without disrupting markets? Is this par for the course? And frankly, is this what the Fed ought to be doing based on the financial risks that are building?
I actually think so. So, I mean, you're right. I mean, there's no way. These markets are so used to, when Scott laid out, well, this is the length of time we look at in the history. Nothing about history is really informative about where we're at today. We're talking about breaking historic norms. We're in uncharted waters, and the Fed has to acknowledge that. With that said, they're ready to pivot. This is a pivotal meeting, but they have to say, we see. This is more inflation than we thought, and some of it is transitory. We don't know how much is persistent given what we're seeing in wages. And we don't want to make a policy mistake by allowing inflation to get more entrenched. We also don't want to overshoot, and the point you made, and that is to precipitate a recession. And I think the risk is that historically, if we really want to think about the Fed, ultimately this agreement on average inflation targeting, which, not including this year sort of, it looks like they're including this year now on the average inflation targeting. And I think that's important. And I think also, it really is just an agreement. It's not a rule that they're living by, and it's a loose agreement. It's a guideline, as my friends in other countries say about some of the rules that they follow on the road. They don't follow all the rules of the road. And I think that's really important, is this is only dependent on how people interpret around the table. And the Fed has ultimately always been more concerned about inflation than employment.
Well said. I was just point out here for our viewers and listeners that full Fed hike now being priced into the end of 2022, at least when you look at euro-dollar futures. Of course, it was already ahead of the game, of course, in late 2023, even before we got the announcement today, Tom. Diane, I am curious about the employment component here, because there are a lot of critics who they would point to the 6-7 million jobs that were still in the hole here and say, whatever happened to getting back to full employment, is that still not part of the equation, or is it part of the equation and the Fed just thinks we'll get there quicker?
Oh, I think it's part of the equation. I mean, the Fed's not going to be raising rates until we get back to full employment. And full employment, the question is, do we count those 2.6 million workers we think have retired out? That changes the equation on what full employment is. It looks like there's a speed limit on employment gains that the Fed had hoped to get million in, million out. We expect to see the economy get back to full employment sometime in late 2022. That still gives us rate hikes in 2023, and that's what the Fed is expecting.
Diane, do you believe in the boom of the service sector, that we've had this good producing consumption moment and we're going to rotate right over to a service sector boom and we're going to get a pretty good Q3 and even a pretty good Q4? Jan Hatzius at Goldman Sachs stunned me today when he talked about a sub 3% American economy out there somewhere. Which is it?
Well, it is out there. It's a little further out for that, but I do think we do have a strong consumer pivot going on already. We know from the retail sales data yesterday the slowness in goods consumption, but the move into the kinds of things we weren't buying, clothing and shoes and makeup and, spending at restaurants in full force. In fact, in inflation-adjusted terms, even though we're still way down in employment at restaurants, we've really seen consolidation in the sector downscale with the big food chains, and that has meant that real spending has actually exceeded its previous peak hit in February of 2020. So you really do see that pivot going on. Consumers are going out to see and be seen at this point in time, and spending is reflecting that. The question is, how quickly do we slow down? And, we have a very weak second half of 2022. 2022, without an additional infrastructure package, even with it, because it's spread out through 8 years, you hit a fiscal cliff in the beginning of 2022. You really got to have, the economy's got to have some momentum there. And it does have some. But that's one of the reasons why he's looking at those slower rates, because as you get in the second half of 2022, you can have slower rates if you've already absorbed a lot of the people who are in the labor market and those who want to be employed. Then you still get a situation where the Fed can raise rates in 2023.
Diane Swonk, thank you so much for being with us today. Greatly appreciate it with our Michigan economics. Greatly appreciate it today. We need to reset. President Biden is in Geneva, ready to board Air Force One. I see our Jennifer Jacobs standing dutifully by, no doubt to ask a rude question. That story continues and will be greeted back in the nation. This is somewhat of a regime shift here in the markets. Lisa, I want to talk to you with a banner, and I really want to talk to you, Lisa, off the banner of the 2-year yield, where finally it moves.
Yeah, this is actually exactly what I'm looking at right now. Just looking at the 2-year yield, it's now the highest since June of 2020. It was up the most since April if you look at it on an intraday basis. Basically, this highlights the surprise to markets, the idea here that we do get some kind of bringing forward of the rate hiking expectations. I do think it's interesting to see yields in the 10-year continuing to creep higher as people continue to digest this. Fascinating to me. How they really actually surprised markets and they're digesting that.
Romaine, digest this for the close. I mean, we got to go through the Fed meeting, and then you've got to reset for the close of the market. And what's it mean for equities?
Well, actually, and we should point out, too, in some of the more recent Fed meetings that we haven't actually seen the reaction come off the release. We've seen the market reaction come off the commentary by Powell, his response to the questions here. So it'll be interesting to see, after we get such a severe knee-jerk reaction off of that statement, what Powell can say to either reverse the tide or maybe even make things worse. But right now, this is a market that is actually, believe it or not, even though it's down, is actually pricing in relatively improving economic conditions, but they're also pricing in the idea here that the accommodation from the Fed is going to be pulled back a little bit sooner than expected.
Romaine, do you assume that equity strategists will have to just completely reset after this meeting?
Well, I mean, I don't know. I mean, it's possible they could, Tom.
I find it absolutely fascinating. Lisa, on the bond market, let's finish up with that before we go to the comments of a chairman of the Federal Reserve. And I've got to go, Lisa, in further. I need to go in for radio. This is such a sight to see. The belly of the curve. And if I go into the belly of the curve, I look at the 5-year real yield. Doug, watch it, Romaine. You've got the belly of the curve going, too. Lisa, I go into the 5-year real yield, and I'm sorry, it's movable versus the 10-year.
Yeah, I mean, honestly, I'm looking at all the way that the market is digesting this, and at first it really took it in stride. But as we continue, you could see people realizing, wait a second, this means the Fed isn't going to be buying as many bonds. And if you look at that real yield on the 5-year, the real yield is negative 1.6%. Oh my God, it's climbed all the way up from a low of negative 1.95%. I mean, it's sort of amazing, Tom, where we are here. Just to put this into perspective, with inflation so high and the way that the Fed has just sat on the front of the curve, perhaps until now.
We're beginning to get research notes in, a few for you right now. Capital economics, always good and very, very precise. Fed sticking to transitory view, but factors in rate hikes as well. Here's what we're going to do. Romaine Bostick for John Farrow with Lisa Abramowitz. I'm Tom Keene here on the radio and television of this Fed Decides. What was going to be a Monday meeting has become much more than a Monday meeting, with the Dow negative 280, SPX down 28 points. The VIX a little bit of quiet in the equity market after the shock.
You see that 10-year real yield, Tom?
Yep. Yeah, the 10-year real yield has come, it's finally coming in from negative 0.90 into negative 0.83. So that's a move there as well. All of a sudden, each question has a value. It will be interesting to see. He's not as timely as Madame Lagarde is, but the shot's a lot better. I mean, Madame Lagarde's cameras are set back in Luxembourg from Frankfurt or wherever, where with Mr. Powell, it's more immediate. Our Michael McKee in the room with the chairman of the Federal Reserve.
At the Federal Reserve, we are strongly committed to achieving the monetary policy goals that Congress has given us: maximum employment and price stability. Today, the Federal Open Market Committee kept interest rates near zero and maintained our asset purchases. These measures, along with our strong guidance on interest rates and on our balance sheet, will ensure that monetary policy will continue to deliver powerful support to the economy until the recovery is complete. Widespread vaccinations, along with unprecedented fiscal policy actions, are also providing strong support to the recovery. Indicators of economic activity and employment have continued to strengthen, and real GDP this year appears to be on track to post its fastest rate of increase in decades. Much of this rapid growth reflects the continued bounce back in activity from depressed levels. The sectors most adversely affected by the pandemic remain weak, but have shown improvement. Household spending is rising at a rapid pace, boosted by the ongoing reopening of the economy, fiscal support, and accommodative financial conditions. The housing sector is strong, and business investment is increasing at a solid pace. In some industries, near-term supply constraints are restraining activity. Forecasts from FOMC participants for economic growth this year have been revised up since our March summary of economic projections. Even so, the recovery is incomplete, and risks to the economic outlook remain. As with overall economic activity, conditions in the labor market have continued to improve, although the pace of improvement has been uneven. Employment rose 419,000 per month on average in April and May, with the leisure and hospitality sector continuing to post notable gains. Employment in this sector and the economy as a whole remains well below pre-pandemic levels. The unemployment rate remained elevated in May at 5.8%, and this figure understates the shortfall in employment, particularly as participation in the labor market has not moved up from the low rates that have prevailed for most of the past year. Factors related to the pandemic, such as caregiving needs, ongoing fears of the virus, and unemployment insurance payments, appear to be weighing on employment growth. These factors should wane in coming months against a backdrop of rising vaccinations, leading to more rapid gains in employment. Looking ahead, FOMC participants project the labor market to continue to improve, with the median projection for the unemployment rate standing at 4.5% at the end of this year and declining to 3.5% by the end of 2023. The economic downturn has not fallen equally on all Americans, and those least able to shoulder the burden have been hardest hit. In particular, despite progress, joblessness continues to fall disproportionately on lower-wage workers in the service sector and on African Americans and Hispanics. Inflation has increased notably in recent months. The 12-month change in PCE prices was 3.6% in April and will likely remain elevated in coming months before moderating. Part of the increase reflects the very low readings from early in the pandemic falling out of the calculation, as well as the pass-through of past increases in oil prices to consumer energy prices. Beyond these effects, we are also seeing upward pressure on prices from the rebound in spending as the economy continues to reopen, particularly as supply bottlenecks have limited how quickly production in some sectors can respond in the near term. These bottleneck effects have been larger than anticipated, and FOMC participants have revised up their projections for inflation, notably for this year. As these transitory supply effects abate, inflation is expected to drop back toward our longer-run goal, and the median inflation projection falls from 3.4% this year to 2.1% next year and 2.2% in 2023. The process of reopening the economy is unprecedented, as was the shutdown at the onset of the pandemic. As the reopening continues, shifts in demand can be large and rapid, and bottlenecks, hiring difficulties, and other constraints could continue to limit how quickly supply can adjust, raising the possibility that inflation could turn out to be higher and more persistent than we expect. Our new framework for monetary policy emphasizes the importance of having well-anchored inflation expectations, both to foster price stability and to enhance our ability to promote our broad-based and inclusive maximum employment goal. Indicators of longer-term inflation expectations have generally reversed the declines seen earlier in the pandemic and have moved into a range that appears broadly consistent with our longer-run inflation goal of 2%. If we saw signs that the path of inflation or longer-term inflation expectations were moving materially and persistently beyond levels consistent with our goal, we'd be prepared to adjust the stance of monetary policy. The pandemic continues to pose risks to the economic outlook. Progress on vaccinations has limited the spread of COVID-19 and will likely continue to reduce the effects of the public health crisis on the economy. However, the pace of vaccinations has slowed, and new strains of the virus remain a risk. Continued progress on vaccinations will support a return to more normal economic conditions. The Fed's policy actions have been guided by our mandate to promote maximum employment and stable prices for the American people, along with our responsibilities to promote the stability of the financial system. As the committee reiterated in today's policy statement, with inflation having run persistently below 2%, we will aim to achieve inflation moderately above 2% for some time so that inflation averages 2% over time, and longer-term inflation expectations remain well anchored at 2%. We expect to maintain an accommodative stance of monetary policy until these employment and inflation outcomes are achieved. With regard to interest rates, we continue to expect that it will be appropriate to maintain the current 0 to 1/4% target range for the federal funds rate until labor market conditions have reached levels consistent with the committee's assessment of maximum employment, and inflation has risen to 2% and is on track to moderately exceed 2% for some time. As is evident in the SEP, many participants forecast that these favorable economic conditions will be met somewhat sooner than previously projected. The median projection for the appropriate level of the federal funds rate now lies above the effective lower bound in 2023. Of course, these projections do not represent a committee decision or plan, and no one knows with any certainty where the economy will be a couple of years from now. More important than any forecast is the fact that whenever liftoff comes, policy will remain highly accommodative. Reaching the conditions for liftoff will mainly signal that the recovery is strong and no longer requires holding rates near zero. In addition, we are continuing to increase our holdings of Treasury securities by at least $80 billion per month and of agency mortgage-backed securities by at least $40 billion per month until substantial further progress has been made toward our maximum employment and price stability goals. The increase in our balance sheet since March 2020 has materially eased financial conditions and is providing substantial support to the economy. At our meeting that concluded earlier today, the committee had a discussion on the progress made toward our goals since the committee adopted its asset purchase guidance last December. While reaching the standard of substantial further progress is still a ways off, participants expect that progress will continue. In coming meetings, the committee will continue to assess the economy's progress toward our goals. As we have said, we will provide advance notice before announcing any decision to make changes to our purchases. On a final note, we made a technical adjustment today to the Federal Reserve's administered rates. The IOER and overnight RRP rates were adjusted upward by 5 basis points in order to keep the federal funds rate well within the target range and to support smooth functioning in money markets. This technical adjustment has no bearing on the appropriate path for the federal funds rate or stance of monetary policy. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to support the economy for as long as it takes to complete the recovery. Thank you. I look forward to your questions.
Mr. Chair. First, we'll go to Rachel Siegel, The Washington Post.
Thank you, Michelle, and thank you, Chair Powell, for taking our questions. I'm wondering if you can walk us through expectations you have specifically when it comes to the labor market going into 2023. And I'm curious about people who may have left the labor market, who have yet to come back, or who may face issues with childcare, perhaps they've retired early, any barriers that you see keeping people from the labor market as you consider full employment going into 2023. Thank you.
Thank you. So I would say if you look at the labor market and you look at the demand for workers and the level of job creation and think ahead, I think it's clear, and I am confident that we are on a path to a very strong labor market, a labor market that shows low unemployment, high participation, rising wages for people across the spectrum. I mean, I think that's shown in our projections. It's shown in outside projections. And if you look through the current time frame and think 1 and 2 years out, we're going to be looking at a very, very strong labor market. In terms of exactly what that means, we'll have to see how things evolve. I think we learned during the course of the last very long expansion, the longest in our history, that labor supply during a long expansion can exceed expectations, can move above its estimated trend. And I have no reason to think that that won't happen again. At the same time, we have seen, in terms of participation, we've seen a significant number of people retire. And so we don't actually know exactly what labor force participation will be as we go forward, but I would tend to look at it and think that it can return to high levels, although it may take some time to do that. But overall, this is going to be a very strong labor market. In terms of the near term, you ask as well. So we see a few things that seem likely to be holding back labor supply. There are very large amounts of job openings, and there are a very large number of people who are unemployed, and the pace of filling those jobs somehow feels slower than it might be. So I'd point to a number of things. The first of which is just that most of the act of sort of going back to one's old job, that's kind of already happened. So this is a question of people finding a new job. And that's just a process that takes longer. There may be something of a speed limit on it. You've got to find a job where your skills match what the employer wants. It's got to be in the right area. There's just a lot that goes into the function of finding a job. So that's sort of a natural thing. In addition, I would say that we look at, for example, a significant number of people still say that they're concerned about going back to work in jobs where there's a lot of public facing because of COVID. So that's clearly holding back some people, and that should diminish as vaccinations move ahead. There's also the question of childcare. Many are engaged in caretaking, and as schools reopen and childcare daycare centers open in the fall, or not in the fall, then we should see that supporting labor force participation by caretakers. Finally, unemployment insurance for something like 15 million people will either end or be diminished as we move through the summer and into the fall by the end of September. And I'd like some that may also encourage some to go back in and take jobs. So you would think that would add to an increase in job creation as well. So you put all those together, I would expect that we would see strong job creation building up over the summer and going into the fall. I will also say, though, the last thing I'll say is this is an extraordinarily unusual time, and we really don't have a template or any experience of a situation like this. And so I think we have to be humble about our ability to understand the data. It's not a time to try to reach hard conclusions about the labor market, about inflation, about the path of policy. We need to see more data. We need to be a little bit patient. And I do think, though, that we'll be seeing some things coming up in coming months that will inform our thinking.
Thank you. Paul Kiernan.
Hi, Chairman Powell. Thanks for the question. The committee's medium forecast on inflation seems to assume a pretty tame outlook for the rest of the year. As you know, the 3-month annualized rate for the past 3 months was, I think, 8.4% in the CPI. And I'm just wondering sort of how much longer we can sustain those kinds of rates before you would get nervous. Thanks.
So inflation has come in above expectations over the last few months. But if you look behind the headline numbers, you'll see that the incoming data are consistent with the view that the prices that are driving that higher inflation are from categories that are being directly affected by the recovery from the pandemic and the reopening of the economy. So, for example, the experience with lumber prices is illustrative of this. The thought is that prices like that have moved up really quickly because of the shortages and bottlenecks and the like, they should stop going up, and at some point they in some cases should actually go down. And we did see that in the case of lumber. Another example where we haven't seen that yet is prices for used cars, which accounted for more than a third of the total increase in core inflation. Used car prices are going up because of sort of a perfect storm of very strong demand and limited supply. It's going up at just an amazing annual rate. But we do think that it makes sense that would stop and that, in fact, it would reverse over time. So we think we'll be seeing some of that. When will we be seeing it? We're not sure. That narrative still seems quite likely to prove correct, though, although, as I pointed out at the last press conference, the timing of that is pretty uncertain, and so are the effects in the near term. But over time, it seems likely that these very specific things that are driving up inflation will be temporary. And we'll be on, we're going to be looking. We'll be looking at the monthly pricing data. I'll also say that the labor market is going to be important both for the maximum employment goal, but also for inflation. And we'll be looking at that. And as I mentioned, we expect, and I expect, that we'll see increases in supply over coming months as the factors that we believe have been suppressing supply abate, wane, move down. So I can't give you an exact number or an exact time, but I would say that we do expect inflation to move down. If you look at the forecasts for 2021 and 2022 and 2023 among my colleagues on the Federal Open Market Committee, you'll see that people do expect inflation to move down meaningfully toward our goal. And I think the full range of inflation projections for 2023, it falls between 2 and 2.3%, which is consistent with our goals.
Thank you. Now we'll go to Ilan Mui at CNBC.
Hi, thank you, Chair Powell, for doing this. My question for you is that you mentioned that your colleagues did have a discussion about the progress that you're making toward your goals in order to consider tapering your asset purchases. In that discussion, you said that you haven't made substantial progress yet, but that you expect to continue to make progress. In that discussion, did you guys talk about a timeline for when you expect to see that progress be made and when you might consider starting to reduce those purchases?
Right. So I expect that we'll be able to say more about timing as we see more data. Basically, there's not a lot of more light I can shed on that. But you can think of this meeting that we had as the talking about meeting, if you like. And I now suggest that we retire that term, which has served its purpose well, I think. So committee participants were of the view that since we adopted that guidance in December, the economy has clearly made progress, although we are still a ways from our goal of substantial further progress. Participants expect continued progress ahead toward that objective. And assuming that is the case, it will be appropriate to consider announcing a plan for reducing our asset purchases at a future meeting. So at coming meetings, the committee will continue to assess the economy's progress toward our goals and will give advance notice before announcing any decision. The timing, of course, Ilan, will depend on the pace of that progress and not on any calendar.
Thank you. Now we'll go to Chris Rugaber, AP.
Right, thank you. Well, you mentioned, let me ask about inflation expectations. You said they were, I think you mentioned in your opening statement that you saw them as within target. Does that mean that some of the shorter term measures we've seen out there, such as the New York Federal Reserve's 3-year outlook, which jumped a bit, should those sort of be dismissed? And are we only looking at longer term inflation expectations? And would you describe those as still well anchored at this point? And on a related note, would the Fed consider publishing its index of common inflation expectations on a monthly basis? Thank you.
So we do tend to look at the longer term inflation expectations because that's really, we think, what matters for inflation. The shorter term ones do tend to move around based on, for example, gasoline prices. So you'll see if gasoline prices were to spike, you'll see the shorter term inflation expectation measures, particularly the surveys, move up. And that's maybe not a good signal for future inflation if gas happens to spike and then go back down again. Yes, I think if you look at the broad range of longer-term inflation expectations, they've moved up. They moved down at the beginning of the pandemic, sort of further exacerbating concerns that we might find ourselves where, for example, the ECB and the Bank of Japan have been, where you have expectations and inflation itself sliding down, and you have a really hard time stopping that process once it begins. So that was a concern. So it's good actually to see longer-term inflation expectations move back up to a range. It's a range that's consistent with what our objectives are. These are not precise measures, and they contain risk premiums of various kinds, and that's why we look at a broad range of them and tend to look at the movement of that broad range of indicators, which are from surveys of economists, surveys of the public, and also market-based. It's a wide index, as I'm sure you know. We look at that and we see them back in the range where they were, and they by the way, they've been broadly higher than that, somewhat modestly higher than that, not so many years ago at a time when inflation was still anchored and at around 2% or maybe even a little bit below. So the answer is yes, I think they are anchored and they're at a good place right now. It's gratifying to see them having moved up off of their pandemic lows. And, as you know, it's fundamental in our framework, our new framework, to assure that longer-term inflation expectations are anchored at a place that is consistent